Okay, we will call the retirement board to order at 3:01. First, board communications. Do we have any communications? Okay, finance director report.
Hello, everyone.
Hello.
All right. So for the quarter ending March 31st, 2024, there was an increase of revenues of approximately $1.3 million from the last quarter. This was mainly attributed to the employee contributions during January, February, and March, along with an increase in dividend income of about $670,000. There was also an increase in realized gain during this quarter of approximately $270,000 as well. On the expenditure side, in total, we're at approximately $9.2 million, or an increase of $3.4 million from the last quarter. $2.8 million of this increase is related to pension payments during the quarter. Also noted that one of the individuals that was eligible to retire had requested to have a lump sum payout, which per the provisions they were allowed to do. So that is part of what's included in that $2.8 million. And then I don't think there was a big fluctuation in our other payments to date with SEIPs or any of those. Any questions on that?
So it was an increase quarter over quarter of almost $3 million.
Correct.
On a base of $9 million. Is that
correct?
That seems like a big, I'm just ignorant. So it seems like a big increase quarter over quarter.
It
That
was
lump sum was part of it.
Yes, it was about $500,000
Okay.
of that lump sum payout for that one individual.
Right. And is it unusual to have swings? Because it's like a 30% increase quarter or right?
I think it depends on the individuals that are being paid out, if there's additional individuals that, or also in this case, I guess it could have been some of the returns of contribution too that were paid out. There was a couple of individuals that had left employment with the town that had gotten payouts of their return of contributions.
So and if it's a silly line of questions, tell me. It's a silly line of question. But so last quarter we had total expenditures of $6 million. This we had $9 million.
Correct.
That seems like a big increase.
Okay. $500,000 would be an unusual thing with that payout.
Correct.
I don't know if we've never seen
It's about, for pension, monthly pension payments, it's around $1 million or a little under $1 million. So so it's not unusual, I don't think, for that amount.
That big of a swing? I mean,
the $2.8 million change.
That's
from one quarter to the next.
Yeah, I didn't see that it was that unusual, but I could go back and look at specifics if you want me to find.
So the expenditures should be generally pretty flat, right? With the exception of like one-time things, which, okay, that 500,000 is one time thing. Everything else should be quarter over quarter kind of flat, right?
For the most part.
And so you'd expect it. Okay, so you had 6 million last quarter. You have one time, so it'd be 6.5 million. Takes a lot of other expenditures to get up to 9 million.
And I understand what you're saying. And of the 2.8, the $500,000, so that would be like 2.3.
Yeah.
So, and there could have been a couple of other pieces in there. I'd have to check on the timing of maybe when some of the SEI fees or Sage View came in. I don't have last quarters in front of me, but
yeah, could you follow up? Just shoot something.
No, I can do that. Yep.
I mean, would it make sense to include like the last 3 quarters?
Absolutely.
Yeah.
Yeah, I could absolutely do
Not
that.
to create any, just to kind of.
Yeah.
Just
So
we
we could,
yeah.
Well, and I can just, the copy of this from the prior quarter or the prior few quarters, just for comparison purposes.
Yeah. And then each time we look at this, to have the 4 quarters or even 5 quarters, so you can look at a year ago.
And then, yeah, for the change for this quarter, to give a little narrative on anything unusual you saw that caused that.
Okay. Yeah, I can absolutely include that for going forward.
It seems super surprising to me, but I don't understand why. So like it's a big giant question mark.
Okay,
Anybody else feel that way? I mean, like,
I wish I'd brought my laptop because then I could have looked
yeah,
up the information while we were sitting here.
Maybe last quarter, it was unusually low.
exactly. We don't know the answer.
We have all this information. I didn't think.
So, yeah, we'll follow up on it.
Yeah, I think it'd be good and not wait till next quarter, but if we could like in the next week or so.
Oh, absolutely.
Have an answer. To
I can
think
send something to John and he
I
can,
think,
Yeah.
as responsible stewards, we should be
For
looking
sure.
at that kind of thing.
Yeah.
absolutely.
Thank you.
Any other questions? Okay, on to approval of minutes. Hopefully people had a chance to read them and I'd entertain a motion.
So moved.
Second, John Burr.
We have a motion by Oppinger, second by Burbank to approval of the minutes for February 8th, 2024. Any comments, changes? If not, all in favor say aye. Aye. Always the same time.
I'm gonna abstain because I was absent.
It is approved. On to authorization of payments from retirement fund for retirement benefits. And again, we usually do this as one motion for the group.
I move we approve authorization of payments.
Motion by Kraft, do a second.
Second,
Second by Freeman. Any comments, questions, before we vote? If not, all in favor, say aye.
Aye.
Opposed, same sign. Motion carries. On to SEI. Matt, how are you? Good, how are you? Thank you, everybody. I'll speak on yours.
Okay, let's turn to page 3 of the presentation. And just feel free to stop me at any time and ask questions. I wanted to put this asset allocation chart back in here again on the right-hand side, because I want to talk about some of the moves we made, even though it's short term. A lot of the moves that we decided together really worked out. And we'll go through that once we get to the performance report. So it's really positive sentiment there. Everything else on the page you can use for your minutes, and I'll control this as we move forward. I'm not going to steal all the thunder from Mark because I know he's going to have a market review. So I'm going to be relatively brief so he can talk about his market stuff as well. We'll start on page 5. So just to back up a little bit, last meeting, we talked about global GDP growth. It was strong in the third and fourth quarter of last year. We expected around 2.1, 2.2%. The first quarter, we came short of that. It was like 1.6% GDP growth. So that shocked the markets a little bit. And then some inflation data as well kind of shocked the market. So we had a pretty rough April where rates were going up and equities were going down at the same time. Okay. But we're looking through March here and everything looks pretty good. So we'll go through the numbers from an index perspective. Large caps led the way. That AI phenomenon continued as we talked about last meeting, followed by small caps, international, emerging market equities. You can see there's a lot of volatility within fixed income because we've had rates going up and down. Specifically, we saw a lot of pressure downward or upward in the first quarter towards the very end of the first quarter. And that can be represented by the teal bar. You can see we had negative returns for core fixed income, which is an intermediate duration fixed income versus a long duration portfolio. The longer duration you are, the longer maturities, the bigger hit you took. So long duration bonds were the biggest underperformer for that period. If you were short duration, you did much better in that scenario. High yield bonds, emerging market debt. High yield bonds were up for the first quarter. Emerging market debt was relatively flat. And then commodities actually was pretty positive, which it was negative when you look back on a 1-year basis. So we saw that. We saw oil prices going up. We saw gold prices, the price of gold going up. Those two main factors really drove that commodities bucket higher as we move forward. On page 6, not much has changed here except for some of the sectors. So when you look at value versus growth in the bottom left-hand corner, value is still lagging growth We already had that conversation. I'm not going to spend a whole lot of time on that. We did have two new sectors that came in front of technology, which technology has been the winning sector for quite some time with that. Again, the AI phenomena, communications and energy came in first and second when you look at it from a quarterly basis, followed by technologies, and financials actually did pretty well also. So we started to see a little bit in the first quarter where other parts of the markets that didn't participate in the previous year started to participate a little bit. And that would be those three sectors. And that's a good thing, right? Because as we move forward, if we run into kind of a recession, which we do on average, have a recession or a market correction every 18 months, right? We could see all those stocks that haven't participated in this strong rally you've had support the market going down further than it actually could. So that's kind of a positive momentum. There's a lot of really strong, good, strong fundamental companies out there that have not participated. You know, and they have low PEs too, like south of 20 price to earnings, south of 20, where you're seeing these technology stocks up in the 40s and 50s and 60s. So they're very expensive stocks. One more thing on this chart, if you look at the top right-hand chart, we have large caps versus small caps. Large caps have done very, very well. Small caps have lagged. It's a pretty simple explanation. Rates are high right now, right, relative to where we were historically. And it costs a lot more for these companies to gain access to capital to fund their operations. You know, treasuries are running at what, 4.5% on a 10-year. They're not getting a loan at 4.5%, right? They're getting loans at 10, 12, 14%. So that, you know, that has caused a problem. Now, if the Fed starts to cut rates, which we believe probably won't be till like 2025, you could see small caps actually take a nice rally as that moves forward. So just keep that in the back of your mind. I wouldn't go all small caps in your 401k, but just something we keep an eye on and then we've been watching. On page 7, international. So there has been areas of the world that have really participated nicely from an international standpoint. Page 7, if you look specifically the regional performance under developed regions like Japan has done well, Europe's done relatively well. And on the emerging market equity side, we saw Latin America do really well. A lot of that can be attributed to the Fed pausing rates, a little bit more certainty around what their next move is going to be, how that impacts currency, and then oil prices obviously definitely help some of those countries in Latin America. So they really did well. Japan, on the other hand, if you remember just 5-6 years ago, we had negative interest rates across the globe with the exception of a couple of countries, the US being one. Negative interest rates. So you had a savings account, you're losing money, right? Japan was the last country that had negative interest rates, and now they're positive. So the whole globe is positive now, no more negative interest rates. That's all behind us. So their economy kind of slowed by COVID significantly, not as much as China, because they weren't as strict as China, but they opened up later than the US and later than other countries. So right now they're flourishing because they're seeing, you know, a lot of consumer spending coming back in, and they're seeing their corporate earnings look really good as a result of all that. So that's why Japan really has had a pretty good couple quarters going back in. If you look at the 1-year number, pretty phenomenal. Any questions around international? Okay. And then finally, fixed income. There's been a lot of movement in the yield curve. So when I that's the bottom left-hand corner, you can see the yield curve here. So, you know, let's say John has a 2-month CD, right? And I have a 10-year CD. John's earning a lot more than I am from an interest rate perspective, right? So that's an inverted yield curve, right? And you can see that on the chart. And we've had that for quite some time. It's starting to loosen up a little bit. But if you go back to 3/31/2023, you can see the bottom bar going across. And then move forward to the past quarter that just passed, you can see yields went up across the board. So that's why we saw some negative returns in fixed income, specifically on the longer end of the curve, those longer maturities, you know, those 10 years, 20 years, 30 years. They took the biggest impact from that. And we saw that with some of the performance that I showed earlier. So the Fed's done. Late last year, many economists believe we would have several rate cuts in the first quarter of this year. Well, guess what? That's not happening. We were in the camp that we'd have 1 or 2 at the end of this year. Now we're pushing that till 2025 for that to happen. Again, the data that came out for inflation in the first quarter could be a little swayed because it's a little bit seasonal. So first quarter data could show really high, but then all of a sudden next quarter we could see lower inflation. So that's what I'm hoping for. Obviously, we're all hoping for, and I would look out for that phenomenon because it might happen. With that being said, eventually we will have rates cut. So where do you want to be when that happens? You want to be longer duration, right? Because you're going to get a lot more return for rates going down 1%. If you have a duration of 10, that strategy is going up by 10%, right? So again, we did some good things here. We shortened duration in the portfolio, and that really helped us through this period. So we'll talk about that once we get into the performance again. Any questions around just the high level market review? Okay, so let's get into the performance. So we'll start on page 13. So I added the fiscal year to date for this report. So now we have that number. And I'll focus on that. And then a couple of pages we have year to date as well. So you can look at it from a calendar year to date perspective. But fiscal year to date, the plan's up pretty significantly, 10.7% net of fees. And again, that outpaced the index pretty considerably there. So that's a positive thing. So let's look through some of the returns. If you look at the blue bar, the blue line that goes across, so we have total equities is up 16.3%. That's total equity as a whole. And the US equity factor base was actually one of your best performers. Now that strategy in particular kind of feeds into what I talked about earlier. It doesn't have those, magnificent 7 stocks, which represent the 28% of the S&P 500 today. It has strong fundamental companies, a lot that haven't participated in this rally. And it also does have access to those companies as well, but a much smaller percentage. So we think it's kind of a good de-risking strategy for the equity side of the equation as we move forward into the future. So that was a great move to make at that point in time. And then you can see international did lag. So that was up about 11%. Emerging markets kind of underperformed developed. So we have 11.68% for the Fidelity Investment Index, and then 6.23% for the emerging market index there. On page 14, here's really where you can see the adding the limited duration and how beneficial that was for the portfolio. So when you look at it from a fiscal year-to-date basis, the fixed income is positive across the board. But core fixed income was up 2.8%. And we pulled 12% from core fixed and put it into limited duration. That was up 4.28%. So that's a pretty significant amount of money that we gained as a result of that strategy change. And then high yield bonds and emerging market debt, we had just 1% in high yield bonds. We got that up to 3%. We got the emerging market debt up to 3%. We didn't have any of that. Both of those had double-digit returns for the period on a fiscal year. Well, I'm sorry, emerging market debt had a 7.44%. When you look at it from a one-year basis, they had really, really strong returns, both high yield bonds and emerging market debt.
When I look at the emerging market debt, I assume that that's a high risk, relatively high risk thing. Debt in emerging markets sounds riskier than
treasuries. Right? Yeah, absolutely.
Or US based.
Absolutely. So when you look at emerging market, I guess we'll start with that. Emerging market debt, about 50% of emerging market debt is actually investment grade bonds.
Okay.
They're global bonds, but they're investment grade.
And they're rated by the Standard Poor's and Fitch.
Yep, they're all rated by that. So there's nothing, there's full liquidity in that market. So there's nothing that's going to get locked up or anything. Okay. It is a 40 Act mutual fund. So, high yield bonds, obviously, the way I look at high yield bonds and emerging market debt, they're really good diversifiers because they don't move like the rest of the market, right? They don't move like fixed income. They don't move like equities. So they're uncorrelated. Mm-hmm. That provides additional diversification over long periods of time. Okay. So yes, they are more risky, but when you introduce a couple of riskier asset classes to an asset allocation, you actually can reduce the overall risk of the total portfolio because of the correlation differences, right? It can smooth your ride out over time.
Okay.
And then real estate, again, this is a REIT fund. So this was up about 9.43% for your fiscal year to date. So really strong returns across the board. from a fiscal year to date standpoint. I do want to just point out the 3-month period, because I want to point out core fixed income so you can see what I talked about earlier. That was down minus 7.4% for the first quarter because rates went up so much, right? And you're further out in the curve, so you took a bigger impact. But even though rates went up, limited duration was actually positive 0.6%, because that has a really short duration. That's on the very short end of the curve, right around 1.5, 2 years, right in between that period, actually. So when rates go up in a shorter vehicle like that, you move into those rates quicker, right? Because your maturities are only a year or 2 years. So you're jumping up to the rates quicker, and you don't have that the impacts of rate movement as much on the shorter end. So that was really beneficial to the portfolio as a whole. I'm not going to spend a lot of time on 15 and 16, but if you want to look at it from a year-to-date standpoint, that matches up with the quarterly numbers anyway. So once we get out 6 months into the year, you might want to look at year-to-date, and because the quarterly, they'll be a little bit different. So, but all in all, just really strong performance from an absolute and relative standpoint.
Now, you guys have made some nice moves, as you pointed out, with duration and just the slight overweighting in domestic stocks versus international. As it sounds like you guys might be forecasting a first rate cut not till 2025. Like, how are you guys thinking about, maybe starting to add to some of that duration to take advantage of when finally the Fed decides they're comfortable cutting rates?
No, that's a great question. It's really difficult to time interest rates. I can tell you, not many people have been successful at that. So we do believe, all in all, you should have a good mix in the fixed income space, right? So you have high yield bonds, emerging market debt, you have some shorter duration vehicles, you have some longer duration vehicles. I mean, I'm not going to come to the board here and say, let's go, 30-year duration in a portfolio, because that adds a tremendous amount of risk, right? If interest rates go up by 1%, you're in a 30-year duration portfolio, that fixed income portion will go down 30%. It's way too much risk, right? So typically we like a happy median, but we might start leaning, and Mark, we'll have a conversation with you about this. Again, timing is very difficult, but eventually, maybe a little bit later this year, we want to move a little bit more back into core fixed income from limited. But I would never take limited off the table, because you're still getting some really good yield in that portfolio, right? You're around 5% yield in that portfolio. So it's good to clip a coupon like that. So does that answer your question?
Yeah. Yep.
Okay. Great.
You guys ever look at annuities or other types of, equity-based things with, in people's personal portfolios? There's all sorts of different things with caps and so forth.
Yeah, we don't really get into the annuity space for pensions specifically.
Okay.
For an individual, it might make sense.
Okay.
You have to be really careful with annuities, though. Sometimes they're loaded with fees you don't even see behind the scenes. I just talked to my mother-in-law about that a couple weeks ago. Yeah, I mean, it doesn't make, now annuitization is a whole different thing, right? So, or de-risking, that's a whole different thing from an annuity, an annuity type product, where you have caps and things like that. So, I mean, there are conversations with some public plans and some Taft-Hartley plans, things like that, where some people are de-risking their portfolio to take advantage of the rates. I'm not a big proponent of that, because we can't time rates. We know we can't. You might get a 5% coupon today, but in order to de-risk your portfolio, you would have to look at your retiree base and say, okay, let's look at the 65 and older retirees, and let's take them out and match their payment streams, right? So that's kind of almost like a LDI type implementation.
If you believed that there was going to be if you knew your crystal ball was really, really good, and you knew that 12 months from now we were going to have a 10-point correction in the equity market, what would you do?
I would stay put, because you're going to have ebbs and flows. And if my crystal ball is really good, well, I'd move us all into treasuries.
Yeah. Well, right. Yeah, I'm just wondering, like, if they're okay, that's fine.
Yeah, I think with that is with any move like that, it's really two moves. It's when do you, if you really felt strongly that we're having a correction and you get defensive, generally the signs are not always there when things are going to improve. And by missing like a week getting back in, you basically gave up what you protected on your first move. So it's kind of not always making the right move, even if you could telegraph it, is, when do you get back in as not to miss out. You've probably seen some of the historical data, if the stock market goes up 15%, but if you were out of the market on the 10 best days, you only earned 5%. So it's kind of the timing of missing out on that quick rally that usually comes when all is pretty dark.
You need a consistently good crystal ball.
You really do.
Yeah.
Actually, a really good example of that would be March of 2009, right? Because the markets were just awful prior to that. Equity markets are down 40%. In March of 2009, the equity market started going up. If you missed just 1 month, you missed out on a 20% return. Approximately. I don't know. It's old data, but you missed out on a huge return just from missing 1 month.
The thinking behind it seems, I don't have any knowledge whatsoever, but we've been having a good run in the equity market for a couple of years. Things tend to correct, and want to make sure that we're fully considerate of what would happen if that were the case.
Yeah, I mean, absolutely we are, because some asset classes in your portfolio would do well during that correction, right? Like core fixed income and limited duration should do well. Your fixed income portion of the portfolio should protect you when the equity is on a downturn.
Great. Thank you.
Any other questions? I really want that crystal ball, by the way.
Yeah.
Thanks, Pat.
Thank you.
Thank you, Pat.
Thank you.
Mark, your turn.
All right. Thank you. Would you like me to present? It sounds like it looks like you have it all in front of you, but happy to present as well. Or show my screen.
You have it in front of it with it.
If you just call it the pages.
Okay, we'll do. So we're gonna go on mine to page 3, which is 48 in the deck. And Pat always does a great job, and their materials are great. They're often similar themes, and we just kind of show them in different ways. So I'll try not to be too redundant over Pat's outlook or review of the last quarter. But page 3 gives us, or page 48 gives us a little hope that we're seeing a more broadening of the market. I know in some of the meetings we had last year, we talked about the Magnificent Seven, some of these AI stocks and NVIDIA specifically, and how much of the gains they made up of the overall S&P 500. This chart is a little bit historic, talks about other periods in time, like the Nifty 50 and the FANG stocks in the early 2000s. And also, takes a look at the S&P 500 on a market weight, which is what we're all used to. It's the top 500 stocks weighted in their market cap. But there are other indexers out there that say, do an equal weight index, invest 0.5%, invest equally in all of the 500 holdings. There's a chart down the bottom that gives a historical look at that. Over 20 years, it's about a wash, either way you do it. But you can see the last 10 years, specifically that gap widening over the last year of the market weighting. And that's because those 7 stocks made up such a big part of the index and had such strong performance. So over the last year, your traditional S&P 500 up 30. If you were to equal weight the S&P holdings, only up 19%, but that we're seeing a narrowing of that gap in the first quarter. So we see that as an encouraging sign, a little bit more participation in the market, because we don't want to be dependent on just a few stocks. And a few of those stocks, the Magnificent Seven, have actually underperformed the S&P 500 as a whole. So just a trend there. The next page, 49, is by the numbers. I think, I like this slide when I'm presenting. It just kind of hits the highlights. Place to be, as Pat pointed out, was blue chip, large cap US stocks, NASDAQ up 9.5%, S&P up 11%. We've got that sticky inflation. So this year has been dominated, almost day to day by, what the expectation of the Fed will do in regards to interest rates. Going into the end of last year, the market had priced in 6 rate cuts. Here we are, almost mid-May, and we haven't seen the Fed budge, and they don't look too close to doing it. So our expectation at SageU is most likely 1 to 2 rate cuts. Every day that passes, or every meeting that passes and the Fed doesn't lower rates, might look closer to 1, but we do feel that we'll see a few rate cuts next year. So I think the trend is in the right direction. It's the timing, probably a little bit disappointing to the market. The market loves rates going down. It's good generally for stocks, and it's almost always good for equities as well, equities and fixed income. I'm gonna flip to the next page, page 50. This is our scoreboard. So we kind of tally what we think is positive, negative, and then, things that are neutral that could maybe swing the economy or the markets one way or the other. So this is very consistent. If you've looked at our materials the last few quarters, employment market, job market's been strong, unemployment's been relatively low. That's always a good thing for a consumer-driven economy like we have in the United States. If we're working, getting raises, Americans are excellent spenders, and GDP is made up in the US, about 70% of it is from consumer spending. So the consumer continues to earn, spend, also use credit cards. Credit debt is on the rise, and defaults have picked up a little bit. The average credit card rate is 21%, which scares me, and especially with both of my children that are in their 20s, trying to keep them away from credit card debt. We added corporate earnings to the list of positives. It was neutral last time, but corporate earnings have generally been strong, beaten estimates, and continue to grow. So we listed that as a positive. We did push interest rates. The writing is on the wall. It's really as early as January, February. You could tell the Fed wasn't going to budge and cut rates 6 times for sure. And like I said, the expectations have been dramatically reduced as we're heading into the middle part of this year. So we'll see. Next time we meet, 3 months of data. We got a jobs report last week, and unemployment crept up a little bit. Wages crept down. The market, even though that's not great news, right? Especially for people that lost their job, the markets kind of cheered that. As they think that might be, more ammunition for the Fed to cut rates in coming months. The next page is very similar to Pat's on 51, showed it a little bit different way. We show 3 time periods, the quarter, which is green, so good news across the board for equities, and we have basically there's a fund for all these indices. The 1 year, very strong, US dominated, S&P 500, NASDAQ. International's been, quietly having some good returns, but underperforming the US. So many reasons, the amount of stimulus we had, a stronger dollar, some of the innovation of these great American companies, just putting, outpacing US investments. But internationals had pretty strong returns. Pat mentioned the 3-year numbers still negative for emerging markets and for US small companies. Small mid-sized companies are more adversely affected by interest rates going up. And then that value growth, another way to show it, a little bit of a better competition. For a while, growth was just kind of blowing away value-oriented investments, but you can see for the quarter, growth up 12, but value up almost 9% as well. So kind of maybe hinting towards that broadening of the rally. I won't spend too much time. 52, I like this slide. It's a little bit different. We've had so many clients inquire about diversification of international investments. I started working in 1991, and saw some incredibly strong years from international and from emerging markets, and really outpaced the US. But over the last 10 years, if you look kind of to the right of that chart, over the last 10 years, the US market has really dominated international markets. So everything is cyclical, and international have its day. Prices are much cheaper overseas. Just always don't have as much support, from the government as well. Interestingly enough, I just was looking at numbers this morning. Over the last 3 months, the best performer has been emerging markets, followed by developed international and kind of both beating US investments. Very short time period, but kind of good to see that diversification coming back into play. 59, I just threw it out there. Sometimes we miss to mention it. For all of our clients, we do quarterly webinar or monthly webinars. These are open to any of our clients and their employees. They're not specific to any 401k or 457 or any type of plan. They're just economic topics that our clients have asked for over the years. It's not product specific or plan specific or anything like that, and kind of open to clients. So feel free to share if you think it would be of value to folks, to your employees. 62 and 63, I think we're covered pretty well by Pat. 64 is similar numbers. It doesn't take into consideration cash flow. So this is basically just taking the asset allocation and playing it backwards. We build a custom benchmark. That's the middle line, custom benchmark. And then we use the average fund as monitored by Morningstar. And that just gives us a sense on, how well are those actively managed funds doing in the plan? Are they, they're giving us some alpha or some outperformance? And this chart actually comes to a nice conclusion. So about up 15% for the year for the Town of Groton fund, slightly above the index, and compared to the average fund out there by Morningstar, we got about 73 basis points of outperformance from our active management. The number over 3-year looks even better. And over 5-year, the funds have really performed well. So we've got about an extra 100 basis points of performance versus if the funds from SEI were just kind of average or middle of the road. And they're doing it with less risk. So that standard deviation number, it's showing there's less volatility with a better performance at a really low cost, 13 basis points. So that's just a great snapshot. I think I went over this when I was in person a couple quarters ago, but I just wanted to point it out. The overall performance has been good. Page 65. So SageView acts as an independent investment consultant. We look at 9 criteria when we look at retirement funds, and then we give each fund a score. 1 is the best score a fund could get in its category. 100 is the worst. On average.
What's
What page are you on?
yeah, this
Oh, sorry about that. 65.
in your booklet?
In our
Yeah,
book.
65. It's 20 on my report, but it's 65
Okay.
in the overall booklet. My apologies.
You're on page 20.
Yeah.
Yeah, okay.
Fund score summary.
Thank you.
Correct. Yeah, correct. Thank you for reminding me. I'll keep an eye on that. So on average, the score is in the 24th percentile, so top quartile. And on the following page, we break the actively managed funds out into those 9 criteria. So as expected, we look at the performance of a fund. We look at the snapshot. How does the 1, 3, 5, 10 look? That doesn't always tell the story. So we look at rolling history, which gives us more data points. We look at the risk-adjusted scores. We look at consistency. We look at up and down capture, how a fund does when the market's up, how it holds up when the market's down. Batting average, kind of a baseball analogy, but it's a consistency metric. And then expenses, of course, which are all top decile. And that translates over to the far right. That's the overall score we give. So if we look at that short duration fund, it scores in the 27th percentile, meaning that it beats 73% of its competition in that intermediate term bond fund category. And then you can see the individual scores. The expense ratio, that 3%, that just means it's cheaper than 97% of its competition. Not that it's a 3% expense ratio. That's the ranking in their peer group. So generally that fund scores well in most of the categories. Most funds are going to have 1 or 2 categories where they don't score particularly well. So everything's passing our scoring. Our goal is to have everything top or second quartile. You'll notice, and I pointed this out in past meetings, the emerging markets debt fund, that's a really small category. I think there's only like 200 funds, where most larger asset classes that you might have 1,700 peers in that fund. So the score will fluctuate a little bit just quarter to quarter as there's jockeying for position, and you could move from top quartile to bottom quartile pretty quickly. So no concerns with this fund, it's passed every time that, since we've added it to the plan a couple of years ago.
If we go back to the previous page, the fund score summary, the 11 funds with the average of 24. Is that a weighted average?
That is a straight average. And then there's a few funds on the next page, we do the index funds on 67.
Okay, so
7
page
active,
22.
and yeah. On 67, we look at index funds a little bit more simplistically, right? Because index funds are really about the expense ratio and how well they track their index. So really expense ratio and tracking error make up about 80% of that score. R squared in beta, which some funds will, can add a little additional performance with if they have lending funds, if they lend out some funds. But the funds we use for the SEI all score right near the top quartile. So it's a straight average of those 11 funds in the portfolio.
I mean, would it be more useful to weight it? Because if we had a lot of our assets in one of the lower performing, although it seems like these are all, I guess there's the 48% score, which is kind of the middle of the pack. But would it be helpful to us to look at the weighted average so that we would know?
I think there's some value in it. I have 2 other clients I do that for. I'd be happy to add it. I can add a line on this page going forward to just, give you a weighted score. I have 2 other, one's a defined benefit plan and one's a defined contribution. They ask the exact same thing. So happy to add it if you think it's useful.
Can you explain to me what that means, the weighted score?
Yeah, so if you look at that page, there's 11 funds and the average is 24. That so on this page, right? So that assumes that, well, if we had all of our money equally distributed in those 11 funds,
Right.
then we would get that 24. But they're not equally distributed. There's more money in some than so what if we put more money in a fund that was performing more poorly or better? That average score it would be weighted by the amount of money in the fund. Right now, all they've done is take each of the funds. So there's 11 funds and they've divided it. They add up the score, and they divide it by 11. That's the number. So weighting it would give more credit to those funds where we have more money, and it would reduce the effect in funds that we have less money. So we'd get a very clearer picture of just how our performance is.
So emerging market debt is getting the same weighting as large cap.
Right. And core fixed income is a really big holding. Obviously having it in the top decile at an 8, that would significantly lower your weighted average, would look much more. I think it would look even better than it does. I think for sure. Yeah, emerging markets only 3% of the portfolio. It happens to get a 48th percentile ranking. So
Yeah.
yeah,
So
I like it.
if we've done a good job, the number will be even better. If we've done a poor job, the number will be worse.
I do caution, the board that Morningstar is a good tool to use.
Yeah.
But if you go out and you pick, let's say you go out and find 5-star Morningstar rated funds and you follow them over the next 5 years, most of them drop off.
They're all looking backwards.
Yeah, so it's all past performance is no guarantee of future.
Yeah.
So
So I just say, like, if we're looking at the SageView score and giving it any credence,
I agree.
we might as well look at it on a weighted basis with the caveat that it's backward looking.
Yeah, and I don't think it would affect any allocation changes, but I think it's just another way to look at the quality of the funds and how well the portfolio is performing overall. I will add that to the next meeting.
Okay, thank you.
And that was it for my prepared comments, unless there's any more questions.
I just have one. When next meeting, if you can, when you refer to the page numbers, if you could refer to our page numbers, because I found it difficult to find out where we were.
I totally agree, and yeah, understand. I'm hoping to be there in person next quarter, but I will definitely do that. it can get confusing with the different page numbers. I like to keep people guessing.
Yeah. Keeps us alert, right?
My apologies for confusion there. Great, thank you.
On to interest rate on employee contributions.
Did everyone see my email about the attachment, and did you need a copy?
I did see it, but I didn't print it.
I apologize.
Was this the email you sent out late today?
It is.
I need to be reminded of I didn't get a chance to read it. I saw something come in, but
Okay.
you'll talk us through this. Okay.
Okay, so based on the retirement board's adopted policy, where we would apply interest rate to the employees' return of contributions for any employees that terminate employment with the town. Annually, we would look at the 120% of the federal midterm rate compared to what the retirement account had earned. So based on the calculation from the resources that I pulled together, I am recommending the 4.62% interest rate be applied, as that was less than the return on market value of 10%. Now, last year, I think based on the accounts earnings, because they were in the negative, we did not apply any interest rate to return of contributions from the terminated employees on their return of contributions. So if you look at the schedule that I had sent out.
And so the background again, the people earn interest.
Mhm.
If what?
If they terminate employment with the town, so if they've been putting in contributions towards.
And then they leave.
Yes.
Vested yet.
Mhm.
They're not vested, but so they've contributed their own money.
Mhm.
It's sitting there.
Yes.
You have to give it back, and then you have to account for them having potentially earned some from their dollars.
And we have a choice as to what the interest rate is going to be, is that?
Well, based on the calculation of what the policy from 1994. It's a calculation based on if the midterm rate that's published as of a certain time frame compared to the interest, the return from our pension account. If we can't go any higher than what the rate of return on the market value of our retirement fund was.
But we have a choice between either the 120% of the midterm or is there any choice here?
No, I think this is based on my understanding, it's for informational purposes only.
Okay.
So when it was zeroed out last year, that's just was a decision, it was just automatic for the
Mhm.
policy.
Correct. Which I think I have a copy of the policy.
Other than the first year, it's always either been the 120% or zero if it's negative. It's always followed that.
Mhm.
So this implies that for the 6/30/2023, we made 10% on the money,
Mhm.
paying that person 4.6. So the difference there is money that is contributed then to
To the fund.
the fund.
It also helps to make up for those years where it was a loss by keeping some back.
Mhm.
Yeah.
See that 25.5 a couple years ago. Can
Yeah.
we do that again?
That'd be nice.
Thank you. Great. Any other business? Our next meeting is on Thursday, August 8th. As of now, is out. Those people are crazy.
Still here, still in the room.
Yes. And I would entertain a motion to adjourn.
So moved.
Motion by Freeman,
Second.
by Pratt. All in favor, say aye.
Aye.
Aye. Same sign. Motion carried. Meeting at 3.
There we go.
Thank you, everybody.
Thank you, Clark. See you later.
Have a good